Good morning, good afternoon, good evening, depending where you are on the planet. And welcome to another Bull versus Bear webinar. Steve Miley on the call here for Trade Day. Welcome, everyone. God, we're kicking off the big few days for markets, right? Haven't stopped banging on about this. To be quite frank, it's going to be a relatively short webinar in here today because there's not much to say, and I've been saying the same thing. Critical is going to be, these next 3 days, I think, today through Friday, with the amount of different events we have, I think it sets the tone for at least the next week, probably for February, maybe for beyond. So obviously we've got CPI as well. Is a critical piece of data that's really been influencing markets. But the amount of data and what we've got coming through. Okay, let's just run through what we've got coming up. So OPEC today as well. Okay, don't forget that we've had so far this morning PMI data out of the Eurozone, mixed bag, mostly better. The larger economies in Europe. Germany, UK beating expectations on the manufacturing side, not by a huge amount, but nevertheless beating. Eurozone bang in line. France, very slight miss. Okay, so generally speaking, they're all positive. Just a thing in here, nationwide house price inflation in here. So this is from the UK. There's a little article on here. UK house prices fall for longest period since 2009. Nationwide is a building society, like a savings and loan in here in the UK. And they've got a long tradition of this house price index in here, so that's not good. The strength of the UK economy partly built around the strength of the housing market, so that's a bit of a negative. And you can see not only is the headline bad in that the longest period, but it also missed on expectations as well. So that's a negative, not massively important probably for you guys, but just goes to show that there are still frailties in global economies, in the larger global economies. But say mixed on the European European PMI this morning. OPEC, I haven't seen anything out from OPEC yet, so still waiting for that. Core CPI actually is a positive for the Eurozone as a whole. Remember, Eurozone data gets kind of a bit diluted, but Eurozone data in here for the CPI inflation data, lower than expected. It's not red, it's positive. Okay, lower is expected, but it's better. The unemployment rate's slightly worse than expected, but marginal in here for the whole of the Eurozone. What we got coming up, well, don't forget, it's kind of gone a little bit under the radar. ADP, I haven't even mentioned ADP. I don't think it's going to have a big impact. The ADP is moving the market less and less these days. Back in the day, 10 years ago when it was launched or wherever it was, before then, used to have a really big following and used to really move the market. Not so much these days. And given, one, the amount of data around this that we have, coming up, and then two, the fact that Fed is tonight, right? Means that how much is the market going to move on an ADP number where we've got the official number, the employment number coming on Friday, and then you got the Fed, just a few hours later. It's probably not going to move too much. So ADP, okay, we're watching it. You're not stupid. You don't just ignore it, right? But equally, keeping an eye on it, but probably not going to be a big mover. Then at 9:45 Eastern, we get the PMI data from S&P Global, but then you got the ISM data more importantly. And again, is it going to really move massively ahead of that? Probably not, but maybe ISM can move markets. So ISM at 10 o'clock. Crude oil inventories. If you're trading oil, okay, it's going to move the market. If you're day trading it, if you're very short term trader, then it's going to move it. But OPEC's going to overshadow it in the bigger picture. That's at 10:30, and then 2 o'clock. If you're in the US this afternoon, early evening. If you're in Europe, we have the Fed. Okay, it's 2 o'clock, the statement and the decision. Statement's important, although I did look at the last statement in here, and there was hardly any change. Fed, but we expected obviously a bit more of a change. Statement tracker, that's the one. I was looking at it earlier today. Was it this one? I think it was this one. This was the last one, November through to the December meeting. Okay, so the change from the November statement to the December statement. They basically, this is the change of the actual percentage change. Okay, so that's just the rate hike. Okay, that's the date change. That's nothing. They changed two words from in the last one, right? Regarding the war. The Russia's war against Ukraine is causing tremendous human and economic hardship. The war-related events are previously it said creating additional, and they changed it to contributing to. So you would argue that's a very, 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 very slight step to a little bit less concerned. Rather than creating additional, it was just contributing to upward pressures on inflation. So that was a very, very slight step, I would say, to slightly more dovish. I mean, the most minimal step. So we're obviously looking at the statement to see if much change there. Obviously, looking at the dot plot chart, right? Are any of the Fed members shifting on the dot plot chart, right? You guys know what the dot plot chart is, right? Well, for those who don't, dot plot chart in here. This is the dot plot chart. So from the Fed, why don't we actually get dot plot from the actual Fed site itself rather than looking at someone else's take on it. Schwab, Federal Reserve. Here it is. So here's the dot plot chart, right? This is actually from the Fed. Some of the economic projections, and here they are. So this is what they're expecting on GDP, etc. And here's the dot plot chart, right? This is from the last meeting, I think. Yep, December the 14th, okay, last year. So this is what they're expecting. So you're probably expecting, if anything, there's potential. It could just be the same, right? There's potential for this to shift very, 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 maybe slightly more dovish. The chances are they're not going more hawkish from here, right? The skewed risk is they're going to go to slightly more dovish. But I don't think the Fed's going to give us that signal. That's the risk. The risk is they give us a slightly more dovish signal, right? But I think the way the market has already started to price in a more dovish tone. If you look at the Fed tool, hopefully I didn't close that. Oh, I did close it. Oh, I didn't want to close that. Let me just reopen that one. The Fed are telling us they're going up to in here, right? So the average for 2023, in here is in the midpoint. Remember, this is the midpoint. So they're looking at it being just above 5. So really they're going from the midpoint between 5 and 5.25. So they're going there, and they're saying 500 to 525, right? 500 to 525 is the range. Okay, so the midpoint is between, you can see in here, there's the dark line's 5, and there's, I'll make this a bit bigger. Let's just zoom in so you can see maybe a bit better. But there, okay, so that's between 5 and 525. So that's the range, right? If we go and look at the Fed tool, what the Fed tool tells us is by May, we're hitting 475 to 500, right? June, and then through the summer, 475 to 500. So the Fed are telling us their peak is likely to be 25 pips, 0.25, 0.25% higher than what the market's pricing in. So the market's already pricing in a more dovish tone than effectively the dot plot chart here is actually kind of telling us, right? So the market's fighting the Fed in here at the moment. The market's more dovish than the Fed. So, but a step to more dovish from the Fed, if they move to where the market is projecting, that's going to be clearly bullish for stocks, right? It's going to be a risk on environment. We're going to have traders taking more risk, and so we'll see a risk on environment, and it will rally on that. So it's all going to be about the Fed statement, and then obviously you got the press conference, and I think it was a press conference about two or three ago, probably around September, I think, last year. And back in September of last year, what we saw, I think it was September. Clinton's on. I think Clinton asked a question about this back then. We saw the market move very kind of significantly in one direction and then back the other direction. And what it was effectively they indicated that they were going to start to cut the pace of cuts, right? It's when they started to indicate they were going to drop from 75 to 50, I think. I think it was then when they dropped from 75 hikes to 50 hikes. Then in the statement, they indicated that. And then in the Q&A, in the press conference, Powell indicated, though, that the market was pricing in rates potentially going to a higher point. All right. So it wasn't kind of a contradiction. What they said was they were going to slow the pace, but they'd probably have to go higher and probably for longer. Right. That's what they kind of said in the press conference. So the press conference can And we are at a point now. Obviously, we've slowed from 75s to 50s, and now to expecting a 25. Okay, and then maybe another 25 after that. They're going to start indicating if they're going to stop. Right, they're going to stop hiking. They're not going to tell you on the day they stop hiking. They're not going to hike. Right, they try and flag this. They're really transparent. There was a day, right? I've been doing this for 30 years. There was a day 20 years ago where central banks were far less transparent. So the interest rate curve and the market was taken a bit by surprise sometimes. And when there was a bigger cut or a bigger hike than the market was expecting, both from the Fed side and other central banks. It was the Bundesbank. I'm talking now pre the euro, right? Pre the eurozone, and Bank of England as well, right? There was less transparency, and interest rate markets used to be far more volatile, particularly on those central bank days, because the central banks weren't flagging, they weren't indicating to the market, they weren't feeding the market information. Today, there's very few surprises when there's a cut or a hike, right? We're not surprised. I mean, the Fed tool tells you that, right? Here we are for today. What's the chances of it being here we are for it today and here? Nailed on that we're going to be up to 450, 475, right? A 25 basis point hike. Actually, there's an outside chance of a 50, right? This column wasn't here yesterday. The column was over this side, right? There was a chance of no change. Anyway, so the market's pricing in, basically nailed on because the Fed's told us, they've effectively told us, right? And they don't want to surprise the markets, okay? So I can't remember where I'm going on this, but my point being, so they're going to try, if we're going to pause, right, as the curve is telling us, the curve's telling us we've got in here one more hike at the March meeting, and then we're going on pause for the summer. Well, they've been kind of telling us that anyway, but they've also told us, right, on the dot plot chart that they're going up to 5 to 5.25, and the market's not pricing that. So someone's wrong, right? And it's the Fed's decision, but maybe this is going to ratchet down, or maybe this needs to ratchet up, right? And we should be up. This column should be bigger, the 500 to 525. So we'll see. But you could get a little bit of a step in here, a little bit of an indication, because they're not going to tell us in the May meeting that's it. The cuts, the hikes are over with. They're going to flag it ahead of time, and maybe 2 meetings ahead of time is time to do that. So it's now. So the Q&A could be interesting, and we could see a notable shift in the statement, more than we saw in this, kind of tepid change of just 2 words from the November through December statement. Right, so we're watching all of these things, guys, right? And clearly, you guys are not going to digest that in the moment. What you're going to do is trade on it immediately. So that's why I'm saying it's almost kind of not irrelevant, but it's kind of what they actually say at the time, and looking at the levels in here, so I'm not going to go through all the levels today. I'll give you a rough take, but I mean, the market's going to move and it's going to accelerate, right? And you've got to decide whether it's a sustained move or not a sustained move. And you're going to tell that in the moment from the price action, right? That's what you're going to do. You're not going to go in and do the macroeconomic study and decide whether what the Fed say. You're going to trade in the moment. That's what you do, right, as traders. So you're going to react to it as it happens. So I'm not going to go into loads of details. Just let you know what the plan of action is today and what's coming and what to expect. Earnings reports obviously today as well. Meta's the one after the bell. So don't forget that as well. It could all calm down post-Fed, getting into the close. After the bell, we've got Meta. If you do close your positions and then reopen, remember you've got that to take into consideration. 5 things to start your day. No surprise, Fed's at the top. Okay. And then the Fed will likely push back against suggestions it will soon halt rate hikes and start to ease policy by year end. Well, you know what? I don't quite agree with that. I don't think they're going to push back against suggestions it will soon halt. What I think they will do, though, they definitely don't want us to be sending signals to the market they're going to start cutting. Okay, even though the market's pricing that in, and we've repeatedly looked at that in here, the market pricing in by November. In here, the rates are going to be either 450, 475, 475 to 500. That's only either 25 or 50 up from there. So it's actually starting to price in unchanged by the end of the year. If we go to 13th, in here, 450, 475, that's up 25 from here. So they are pricing in 1 rate cut. So remember, previously in here, they were pricing in 2 rate cuts by the end of the year. So back to where we are now. 225s up, February, March. Flat through the whole of the year. November, December, 225s down, back to where we are right now. at the 425, 450 target rate range. Okay, now we're more saying 450, 475 at year end. This is the 13th of December meeting, which is 25 up from there. So the market has started to react already to the Fed keep reiterating to us we're not going to be cutting anytime soon, kind of stuff. So the market has reacted to that, and I think that's the message they want to send. So I don't quite agree with that. I think they do want to start suggesting if they are going to start halting rate hikes, as the market is fully pricing in. If they're the Fed's telling us they're only going to 5 anyway, right? 5 to 5.25. They've only got, if they do 25 today, they've only got 50 to go. So they need to flag to us when they're going to end. So the Fed, I think, will flag to us that they were going to halt at least in the next 2 meetings. But are they? They're not ready to say they're in any position to cut. They don't want to be saying that in case they're in fact in anything. Maybe they're going to have to restart hiking if inflation starts to pick up again. Right? They might have to hike again. So they might go on pause and then hike. They don't want to indicate they're going to cut, and then the market's completely the wrong way around. Okay. Housing slumping year. UK house prices. We've spoken about that. Adani, I don't want to really go into focus on loads of this. Yeah, okay, it's wiping, the world's richest Asian man is no longer the world's richest Asian man. And the Indian stock market is getting hit by this. And it's causing some issues, but not really feeding in at all into the wider European, US, and even Asian markets. It's not really having an impact. Futures and Nasdaq contracts fall, but fell and bounced. Okay, so we're actually rebounded in there. If we go and take a look at where we are right in here right now, European bourses are actually up, following on from the rebound in the US yesterday. And US in here, futures, or actually they've got us now. I see us now. I think this is just a bit behind, right? I see us as up. But I think that's up from the close maybe on the day. If I go and take a look at the chart in here, I see us as well, actually pretty much unchanged now, the S&P. When I think I kicked off the webinar, but Nasdaq's actually up. We're actually up on the Nasdaq, right? Going into today. So I think that's a little bit behind on the current price action. So for me, I mean, I'm coming into this, it went right down to the levels. I spoke about this trend line in here yesterday. Maybe it'll go and taste this impulse point. You look at the 13-period exponential moving average. I do like the 13-period exponential moving average. It came right off of there yesterday, ahead of the trend line, just held just above the 13-day exponential on the S&P 500. We breached the trend line there, and also the 13-period exponential moving average, as it did last week, and then closed back above it, and a really strong close. Bullish outside day on the S&P. So really rejecting the negative tone that we saw from the prior day. For me, this is all pointing higher still. I think the market wants to rally. The market is looking to rally. It needs the Fed to deliver us. I mean, even the most minute dovishness. If they don't do that, I think it could dip. If it does dip, I think it's a dip and a buy, right? I think it's a buy on the dip, okay? So unless they are particularly hawkish, right, which I don't think they will be. So if they're particularly hawkish and it's one-way traffic and it's straight down, you don't fight it. If it does go lower, I think you're short, you have to be very agile and get ready to get out. I think it could easily rebound in here. So watching out for the rebound, okay, would be the way I would approach it. In fact, the way I am going to approach it. This is what I'm going to be doing. I'm going to be waiting and probably looking, unless I'm going to quickly look at the Fed statement. I'll be watching the Q&A in the press conference. And if there's any hint of it, them actually shifting significantly or staying on a very hawkish path, this could be notably lower. I think what it will do is they're not going to deliver the dovishness. The market will be disappointed in them not delivering dovishness. It doesn't mean they're hawkish, but I think the market's building itself up for a more dovish comment. I don't think they'll deliver it. The market will be disappointed and sell off, but then it will rebound because the market wants to rally anyway. And it'll only go down if they actually deliver something that's actually hawkish, not de facto hawkish by not being dovish, if that makes sense. If it doesn't make sense, ask me in the chat to repeat it. But I think that's my take on it anyway. Going into today, Fed expected to slow rate hikes in signals works not over. Okay, so yeah, I mean that's what we're saying, right? They're going to signal that we're coming to the end, but it's not expected to. So that statement could have soft language around ongoing increases. Okay, so if we go back and look at the statement in here. Oops, the wrong one. Dot plot chart in here. Ongoing increases. I don't know where that is. Ongoing increases. Let me see if I can find it. Do I find in here? Where are we? Ongoing increases. Ongoing. Okay, the committee anticipates that ongoing increases in the target range will be appropriate. So maybe they won't say ongoing increases. That's what they're saying. Ongoing increases in the target range. What they might moderate that language. So we're watching out for that part. Is what this is telling me in here. Okay. So where is that? What to expect? Okay, what to expect in here? Where's the saying? Oh, we're going to go and these are the raise rates to say the peak for quite some time. Yeah, so the policy rates to say at the peak for quite some time. Okay, so I think that's they're going to signal that the peak is near. Okay, and that will be that ongoing increases. Okay, so it's not ongoing because maybe there's only going to be one more, right? Yeah, they're highlighting here. Speculation the peak rate is close is leading to questions about whether it's time for the Fed to adjust the wording in its statement that says ongoing increases. Some see policymakers risking an overly dovish signal to market if they adjust the statement while also stepping down to smaller rate increases. If you soften that, you're probably saying that your terminal rate, your anticipated terminal rate, is lower than it was in December, and you're a lot nearer to the terminal rate than you were before. Okay, I don't think they want to communicate. So will they or won't they? Okay, so that's what we're looking for really in their ongoing increases. Do they moderate that or not? Okay, so that's what you're looking for in the text. You're not going to beat the algos. The algos are looking for that, and they're going to read that in a fraction of a second and jump it before you can click the button. So it's a matter of reacting to the price action rather than trying to read it yourself. Okay, yeah, the price action is going to be quicker. The algo is always going to beat us, right? Until we get our Cybernet upgrades. Skynet, not Cybernet, Skynet, right? Okay. What else? What else is there? I covered that. Yeah, so we're up a little bit. Yeah, I mean, not much to add in here, guys. I'm going to wrap it up there, I think. So for me, this still looks bullish. Stocks look bullish in here. A quick nod to the commodities, and it will be a quick nod. In here, oil, big dip and a big rebound in here. We spoke about only having 3 days down and then rallying. Look, 3 days right the way through this whole rally. You haven't had more than 3 days down. Okay. And so yesterday we got 2 days ago, we got kind of a third day down. Yesterday, spike down, rebound. Look at the way that 13-day exponential moving average has held, right? So avoiding closing violations of it. Okay. All the way since back here. Haven't closed below, I don't think, or just to close below there. Just to close below there and then quickly back above. Minimal close it below there. And then yesterday spike below and close back above. This for me is pointing up. So gold up. Remember, even though gold's a safe haven, it's moving with risky assets at the moment because of the inverse relationship with the dollar. Okay, so you saw last year, obviously, gold sold off with stocks and gold is now rallying with stocks. So it's actually acting more like a risk asset, even though traditionally it's a safe haven. And a quick nod to oil. In here, obviously all about OPEC, right? But also the Fed's going to play into that, so we're waiting for OPEC. But again, kind of rejecting there. Big rejection candlestick yesterday. Hammer, sort of like a big hammer, sort of like a hammer, not quite a hammer. Pushing higher again today, recapturing back above the 13-day exponential moving average. Don't think it's as relevant now. Once you go into range, which we are, it's less relevant. But nevertheless, that's for me is pointing back higher again. That sits up with the risk on view. Any questions? I'm not going to go into details, more minute levels on the charts because they're going to get blown away. All those minute levels, and I wouldn't suggest you have, kind of bracket entry levels. I wouldn't have stop entries, because you can get whipsawed on this stuff. You're better off pulling the trigger, sitting there watching the price action, and pulling the trigger yourself. Okay, but that's up to you guys. That's it for me. I'm going to wrap it up there. No questions coming through. Wish you all a great trading day. Helmets and goggles for the Fed. We've got all the other stuff around that as well. PMI data ahead of there. Meta afterwards. And then we've got a huge loads more coming up Thursday and Friday as well. But I'll cover that tomorrow. Take care, guys. Have a good one. Bye.